Connect with Saurabh Mukherjea. Let's talk and understand from him what exactly are markets expecting from budget, what he makes of the numbers so far, and at a time when some of the high quality stocks are getting punished, is it time to revisit some of them? Saurabh, great to have you back. Thank you for joining us. What to your mind is the big moot point for 2023? Variety of trends are now visible. Tech is under pressure, banks are flying, high P stocks are getting crushed. How would you summarize the first initial overs of 2023?
I think it's a mixture of two things. One is from an Indian perspective, from a domestic perspective, the economy clearly is in fine fettle. I think we can't but look at the result season and conclude that the result season so far suggests that economy is in fine fettle. Whether you look at the banks' results, even Havells' result, even the Asian Paints, also the top line print is flat. The fact that operating margins are up 400 bips suggests that as a country, by and large, across sectors, financial services, IT exports, domestic manufacturing, we're in reasonably good shape. The challenge for us in India is that the rest of the world isn't in good shape, and specifically, the rest of the world still hasn't made up its mind as to when to start pulling back interest rates. Whilst both Europe and America have had a couple of CPI prints which are moving south, moving down, it's not yet decisive enough, I think, for their central banks to start signaling that the rate hike cycle is done. And I think until such time, global investors' mood will remain a little jittery. Remember, most global investors haven't seen they haven't seen rate hike cycles this powerful ever in their career. In fact, even in my career, I've never seen a 1 year period where the US rates go up 400 bips. So domestic economy in great shape, global risk appetite still soft. And until we get clarity on the global inflation picture, more decisive clarity, we're getting incremental clarity that the inflation picture is coming off. But until decisive clarity emerges on that, I think we will see a degree of trepidation across the world on equities, whether it's Indian equities, American equities, or indeed European equities.
So a lot of folks are saying a State Bank of India fixed deposit is giving 9% return. Interest rates sooner than later will peak out, which means bond would be attractive. So if you're buying into equities now, you're buying the market at a reasonable level. And if the possibility of a 10% return, which is a probability, versus a 9% assured return in State Bank of India fixed deposit or a double-digit return in debt, one should go for the latter, not for equities.
Yeah, so I think if you lived in a developed country and you got 9% on an FD, I would say take it every time. If I lived in a developed country and I got 9% on an FD, I would take it. But living in India and taking 9% on FD, even 9% on FD, I'm not so sure is a great long-term idea. Primarily because inflation for people like us, those people who are watching, inflation for us typically is around 6-7%. Our cost of living tends to go up a little higher than most other people because there's a huge imported component in our cost of living. And 6-7% inflation means that if your FD is giving you after tax, say 7%, you're not really creating wealth. Now, some people might be happy not to create wealth, but most people in my generation, most of my client base, want to create a degree of wealth for themselves. And I'm afraid that's not going to come from investing in fixed deposits in a country like India. That's only going to come from investing in high quality equities. And hence the premise that I put forward in my books over the last 4 or 5 years, that buy high quality companies, sit on them for long periods of time, and see your wealth expand at anywhere between 15 to 20%, depending on your portfolio and your patience. But the era of investing in FDs and creating wealth, I think that sort of ended roughly 20 years ago.
Let's look at your portfolio companies which have come out with numbers so far. Asian Paints yesterday, ICICI Lombard I think earlier this week, HDFC Bank over the weekend, and TCS was the first one to come out with numbers. What's been the standout miss for you? What's been the standout hit for you?
I think the sort of the most positive development I can see is right through last year, people kept telling us, they kept telling each other that there's a global slowdown, IT services will be hit, and people like us kept saying, and I think I said it several times on your show, Nikunj, that I don't understand how you can be bearish on IT services. It's like being bearish on steam engines at the heart of the industrial revolution. So I think this time around, I think fairly convincingly, not just TCS but also Infosys, even HCL Tech, results quite convincingly show that regardless of what happens to GDP growth in the Western world, the migration to cloud, outsourcing to India, these are incredibly powerful themes that will power through an economic slowdown, and that sort of reinforces our faith, which is why at one level actually in our mid cap portfolio in Rising Giants, we've gone ahead and added Tata Elxsi. So over and above L&T Technology Services, which was already our existing engineering R&D play, we've added another engineering R&D play, Tata Elxsi, similar sort of drivers. The West needs more Indian help for engineering, for research and development. They don't have that many STEM graduates. We have more STEM graduates. We have high quality companies with great pedigree. So I think this area is something we'll keep looking to build on. A decadal 10-year surge in Western intellect related work migrating to India. The area where we're a little circumspect, and you could see that say both in Asian Paints results and also even Havells results. We don't hold Havells, but I think in electrical it's a good benchmark to observe. There's a degree of top line softness in Asian Paints' case after I think 3 years of blistering top line growth, where I think they CAGR'd at 17%. You had a soft quarter on the top line, but thankfully it's made up by the fact that you've seen EBITDA margins recovering as the global commodity wave ebbs. Asian Paints, I think, saw a 400 bps jump in EBITDA margins. So we'll look forward to see when the top line growth picks up a little bit. I suspect that might take a couple of quarters. But it's good to see EBITDA margins recover. And I think we'll see this across the market. The commodity price inflation surge is broadly done. And I think operating margins will recover both the quarter that ended in December and I think also the same story in the March quarter.
I'll ask you a question which perhaps is more like a association that Saurabh Mukherjee has, that he's married to some of his favorite stocks forever, Kotak, HDFC Bank, Asian Paints. Is that true, or these are purely based on your conviction, not about sentiment? I mean, if these companies don't grow, Marcellus will be happy to sell them or get rid of them.
So before I start comment on that, so quick disclaimer in a way related to my investments. I have invested all of these stocks. My parents are invested. Our 10,000 clients are invested. So there are large amounts of money invested across my family and our client base. So come back to now your question, Nikunj. So it's a very interesting thing, right? So as a country, we raise our children with huge amount of care, love, and affection, right? And we nurture our children. We give them the best education we can. We hope that they go to university, do well in life, and so on. And yet we have a very mercenary attitude towards stocks, right? So some people buy on PE multiples. They sell on a beat. They sell when results are a little weak, or they buy when results are a little strong. And I've never quite understood the dichotomy, right? It's not as if you and I are living in a country where there are plenty of high quality companies. That's not the case. We're living in a country where high integrity promoters with high competence, the combination of integrity and competence is super scarce in India. Right? We're only a 25-year-old free market economy. We're not a 100-year-old free market economy. We don't have a very large pool of high integrity, high competence promoters. That pool is very small. Within that small pool, what we have done is across our portfolios, identified roughly 30 promoters / management teams. And to us, they're almost like relationships to be built, businesses to be nurtured, rather than to be dealt with on a mercenary basis saying PE multiple has gone up or EBITDA margin is weak and get out. Where we sell is when we see a promoter either lose integrity or show incompetence. Integrity and incompetence are a big deal for us. When we see demonstrations of that, we head for the door. We don't sell companies just because a quarter has been weak or the Indian classic PE multiple looks very high.
Saurabh, hi there, morning. You've always maintained your stance that, you've historically avoided PSUs, and that's going to be a strategy that you will continue to adopt. But given the fact that now we're seeing overseas investors, returning to some of these stocks, the likes of NMDC, IRCTC, BHEL, etc., there's going to be no change in your thesis?
I mean, look, I mean, whether overseas investors buy or don't buy PSUs, it's not part of, in a way, it's not our concern. Whereas I've said historically, our concern on PSUs has been the PSU serving two masters. It's serving its owner, Government of India, quite rightly. The government owns the PSUs to propagate a bunch of goals around national development. So, for example, the government owns Power Grid or NTPC or Coal India to make sure that you and I get affordable electricity, and the same is rolled out across the length and breadth of the country, right? And therefore, the PSU's primary responsibility is to serve its master, the Government of India. A secondary responsibility is to serve shareholders. And that's why our belief is it's difficult for a PSU to generate results for our clients over long periods of time. They will have these bursts of activity in the share price when, say, Coal India goes up 60-70%. That's fine, but to the extent you and I, none of us who's on the show know who's going to be running Coal India or Power Grid or indeed State Bank of India or Bank of Baroda. We don't know who will run that PSU 5 years hence, and therefore we don't quite know who exactly are we backing. What we do know for sure is the master of these companies, the owner, will be primarily Government of India, and these companies therefore have to serve the national imperative, not the minority shareholders' interests, and hence the avoidance of PSUs in Marcellus.
Good morning, Saurabh. This is Nayantara also joining in on the conversation. You've spoken about IT, and that's where you talked about adding Tata Elxsi, already have L&T Tech. That was in response to Nikunj. But the question I want to ask was, and what we've read, that you chose Tata Elxsi after dumping Relaxo. Why did you exit Relaxo?
So we've held Relaxo for 6 years. We've been very happy shareholders. We're extremely thankful to what the remarkable Dua family have done for not just us, for their other shareholders. They've built a company, market cap approaching $3 billion, dominance in the entry-level footwear market. Remarkable people, remarkable achievement. The reason we exited is, as we saw through COVID, the low-income strata of Indian society getting pulverized, right? We were not alone. You would have seen it in results of numerous companies. I remember through COVID, HUL having a really tough time. FMCG companies had a tough time. Domestic pharma companies struggled on domestic volumes in the wake of this. So COVID pulverized the weakest economic strata of our country. And unfortunately, after COVID subsided, you had this brutal wave of input cost inflation after Russia attacked Ukraine. In that input cost inflation wave, Relaxo pushed up its prices, especially for entry-level footwear. I remember through last summer we were tracking this, so I keep going to Amazon and checking out their entry-level footwear prices, and I saw the price of that chappal jump from say 80 rupees to 150 rupees, and that's when we knew that this is going to be tough, because you can imagine for low income people, 150 rupees is a steep price to pay, and that was where I think the challenge began. They lost market share as a courtesy that price hike. The unorganized segment, which uses low quality inputs, gain market share at the expense of Relaxo, and also some other organized players from South India invaded the north. So we thought about it long and hard through the last 6 months of 2022, but ultimately we made the call that given the changing economic realities of the country, especially for low income people, it's going to be difficult for us to compound here at 20% for the foreseeable future, and hence the exit from Relaxo. Remain huge fans and admirers of what Mr. Ramesh Dua ji and his family have built, which is something quite remarkable in the last 30 years.
Okay, so that's the reason why Suarabh Mukherjea has exited Relaxo, and earlier explaining why the entry in Tata Elxsi. Incidentally, he's come out with a new quant strategy where with the portfolio we'll see a bigger churn. But on that, next time, Saurabh. Thanks a lot for being live with us today.
Thank you, Nayantara.
Well, we're going to take